Thank you so much for joining. Welcome to today's webinar from EVORA. I'll be your host today. My name is Ed Gabbitas, and I'm based out of our New York City office. In terms of background on me, I'm one of EVORA's co-founders. I'm currently serving as our head of North America. The purpose of today is to hear about how sustainability is adding value to real estate investments, and particularly in the value add space. So we're going to hear from three fantastic guests, which you can see in front of you. But please do get involved. Use the chat function, so we know the Q&A function, which will be somewhere along the bottom of your screen. Add questions. There's lots of people online. The numbers are growing. So take this opportunity to ask these experts exactly how they're addressing ESG, sustainability, climate, call it what you want. Rather than wait until the end for Q&A, I'll try and dip in and out as we go through the session. So, if you do have something, don't hold on till the end. If it's a burning question, ask it as you think of it. That would be much appreciated. But just as an intro to EVORA, as we wait for the numbers to pick up, we've been operating for 13 years now. We've grown from 3 founders back in 2011 to over 250 people, spread across North America, UK and Europe. And our focus really is providing sustainable solutions to real asset investors. We work with around about 150 clients, acting as their trusted advisor. And we do that across 3 broad spectrums. First of all, it's helping funds and firms to set strategy on things like climate risk, sustainable finance. Second, it's what I call getting stuff done at asset and fund level. So that's everything from due diligence to energy audits, reporting on things like GRESB, everyone's favorite, and PRI. And finally, we're tech enabled through different platforms which support on all things data related in terms of automation, verification, transformation, and the representation of those risks and opportunities through our platform, Sierra. Okay, so that is enough from me, enough about EVORA. Now turning over to my guests. I'm delighted to have such esteemed company with me today. So I'm going to ask each of them if we just hear a little bit more about who you are, where you work, and what you do. Inga, I'll come to you first.
Hi there, everyone, and thank you very much for joining us this afternoon. My name is Inga Ahaneku. I'm the head of ESG for Mark Capital. Mark is a pan-European investment manager. We have multiple funds. They are ranging from value add to standing assets. We've got last mile logistics portfolio Crossbay 2 underway. And we also hold portfolios across retail, residential, and commercial office space.
Thanks, Inga. Ryan, I'll come to you next.
Yeah, thanks, Ed, and thanks for having me. I'm Ryan Ray. I lead our ESG performance team globally at TPG, focusing on our private equity strategies across a number of different verticals, and then also our real estate strategy as well. Globally, we predominantly invest in value add and opportunistic strategies, also have some core plus funds as well, and have been happy to work with EVORA on a number of different initiatives, predominantly around regulatory preparedness, fund strategy, and then also GRESB reporting.
Thanks, Ryan. Always appreciate a plug. Sonny, coming to you.
Thanks, Ed. Hello, everyone. I'm Sonny Masero. I'm Managing Director for Global ESG at Hines, picking up the baton from Peter Epping, who many of you probably know from the past. And Hines is a privately owned company run by the Hines family out of Houston, Texas. We manage an investment portfolio of around $93 billion in 3 main regions around the world, including North America, Europe, and Asia Pac. And then we also manage a portfolio on behalf of other third parties, as well as developing and operating real estate ourselves to have that vertical integration, which definitely helps when we're thinking about sustainability strategy and how to implement that through the business.
Fantastic. Thanks, Sonny. Thanks all. So as we heard, lots of scale, lots of expertise. So as a reminder, do use the Q&A function as and when questions pop up. Before we begin, I was just going to take a bit of time just to set the scene and explain, why are we here today and why are we specifically talking about value add funds. So it's not new news to those in the audience that real estate has faced some headwinds in recent years. Some sectors particularly were hit hard by the pandemic, particularly affecting working patterns, work from home, and the transition to e-commerce. But people on the line will know that this is not a uniform statement that real estate is significantly troubled, and particularly there's a lot of opportunity in certain sectors. I'm increasingly hearing people talking about golden vintages as the bottom is almost being called in many markets. But it is a fact that the industry across the industry, we're facing unprecedented high interest rates. So from a returns perspective, this is really impacting how investors perceive the value of real estate versus other asset classes they may invest in. If you consider the risk-free rate, often measured by the 10-year Treasury yield from the US government, which in recent times has been as high as 5%, and you compare that to the typical return of a core fund, which is often between 6 and 8%, for argument's sake, the risk-free premium, that being the difference between the risk-free rate and the return that you're seeking to get, reduced it to somewhere around 1 to 3%. So when you factor in the illiquid nature of real estate, together with inflation, it makes investing in core funds in the current environment, less appealing than it has been when we experienced those lower interest rates. So as a result, we're seeing investors seeking to move further up the risk curve so they can achieve higher returns. Sometimes that comes at the consequence of higher risk, hence the focus today on value add. So the last thing I say, the goal of value add, it's fairly simple. You devise asset management strategies that either reduce costs, increase rental income, or other revenues, or ideally both. And there's different strategies that can be taken to achieve that repositioning. And quite often, the reason you're taking that action is to increase the desirability of these assets to those core fund players. So today we're going to explore how and why sustainability is well positioned to support value add funds, despite the shorter hold periods that this segment of the market has. So I'm going to turn that over to my guests now, so we can start to explore certain areas around why sustainability can add value from their perspectives. But I'm going to start things by kicking off around that question around investors and whether or not they are you are seeing the move up the risk curve, and also how does that change their sentiment on sustainability and ESG. So let me turn it over now. If I ask that question, who would like to take their first stab at that in terms of the investor response that you're seeing in the current market environment?
Yeah, I can talk a little bit about that, just from kind of TPG's perspective, and then kind of what we're observing more broadly. I mean, I think that if I just level set a bit, the fundraising environment's hard. I mean, we have a lot of terms about like the denominator effect and things like that. People having less allocation to core, that transitioning to other strategies, even outside of real estate, et cetera. So, I mean, I think that that's level setting a little bit. So, an apples to apples comparison of where we were and where we are today is a bit difficult. And what I can say, and this has been kind of from some recent interesting studies and panels at some conferences I've been to recently, is what I can say is that the amount of dollars that core funds specifically have to allocate to core products is decreasing relative to, not in absolute terms, and also to the relative portion of the pie. So I find that pretty interesting. So, I mean, I think that tends to show that maybe value add or opportunistic funds are having an easier time during their raise. But what's also true there is the group of folks that will buy value add or opportunistic products that have been transitioned to the core plus buyer is necessarily lower. So I think that that's been kind of the push and pull of the fundraise perspective, but then also just what's available upon exit for the people that are raising right now. So I think that that's pretty interesting. And then, you know, we're also a pretty big credit manager. So ideas of launching commercial real estate debt or high yield distressed debt specific to the real estate environment has been a pivot as well. But again, under the idea of higher yields relative to typical returns.
Okay, thanks, Ryan. Sonny, I saw you come off mute next. Anything you'd like to add?
Yeah, just to build on what Ryan was saying, I think I would definitely agree that it's been a hard capital raising environment for everyone. But I think from a Hines perspective, we have seen continued interest in our value add funds. You would have seen in the news that our European value add fund 3 exceeded the target that we set for capital raising at the end of last year. And I think this is a good topic to talk about because that increased appetite for risk leans into what's needed in terms of being forward looking around sustainability, because the sustainability agenda is moving fairly rapidly, both in terms of the regulatory environment, but also changes that we're seeing in the market, whether that's changing appetite from tenants for different sustainability aspects, or even from next buyers, or whether we're talking about, you know, the rise of extreme weather events, which we also need to respond and adapt to. So I think as one of our value add fund managers said, actually in Asia Pac, you know, the fact that spreads are thin, it does mean that real estate value creation is becoming much more important perhaps than financial engineering. And that's very much that focus in on creating alpha through sustainability is something that's central to our value add strategies wherever you are in the world. And we have seen interest from investors, particularly in brown to green strategies, as part of that value add portfolio. Inga.
Okay.
Yeah, I'd agree with that sentiment, and that has been building over the last couple of years, you know, in alignment with you know, global economic events. I think investors have been looking for value add alongside diversification, and you know, there are probably multiple factors in that risk profile appetite change. And, you know, Ed, you mentioned a couple of those, but I think also the opportunity to add value from a sustainability perspective, in which then creates liquidity, you know, within those assets, is fundamentally what I think the not the realization, but the movement is headed, you know, more toward. And I think actually just talking about our last mile logistics value add fund, even the diverse kind of sectors have a lot of flexibility around value add, particularly in the sustainability sense. And I think people have appreciated that it's not necessarily just around that, you know, typical asset classes of office, resi, retail, but it can be quite significant in the kind of you know, more niche markets, such as we're seeing.
Yeah, it'd be great to explore different sectors as we go through the conversation, and just see if it's a similar approach, different approach, regionally as well. I guess what I'm hearing there is that, you know, the requirement, the expectation for sustainability, ESG, climate, call it what you like, is still top of mind for investors. I guess, you know, more broadly, call it risk management, which of course it is. So it'd be interesting to hear, you know, how your firms are responding to that. There were some comments you made, Ryan, about the you know, reduced availability on exit. Inga, you talked about improving the liquidity. So maybe on the way in, at acquisition stage, which is of course a key part of value add, that's where you develop your strategies. It'd be great to hear, maybe if I come back to you, Ryan, you know, in what ways has your approach, you know, changed to sustainability, to thinking about those risks, you know, in the current market versus, say, you know, 5 years ago?
Yeah, and that's an interesting question, Ed. And I think that, and this kind of dovetails off of your last question regarding what are you seeing investor appetite circulating around from a sustainability perspective. So I'm not sure the sustainability interest has necessarily increased overall, just because I think it was potentially there before, and maybe that's a little bit of a recency bias on my part, but I think it's gotten more specific. And what I mean by that, instead of the questions that we'll have in an RFP or in an investor meeting or kind of with a buyer, the conversations were kind of what's your ESG program? What are you a signatory of? What are the high level commitments that you've made? And now it's questions like, do you use the CRIM tool specifically in your diligence processes? Do you kind of look at physical climate risk? And not only do you, but how do you? How is sustainability actually modeled into your business plan? So really specific questions that have led to a pretty specific set of process responses for us. So just to kind of clear the air, TPG does not have any firm level or real estate fund level decarbonization targets. In our European real estate value add fund, it's an Article 8 aligned fund, and we do have process-based commitments. And Ed, you know this intimately well because we worked with you on this. But the process-based commitments revolve around what we call enhanced ESG diligence and sustainability integration in the business plan. And that has to be proved out with the specifics of, commissioning and reviewing whole life carbon assessments, things like physical climate risk, things like, again, benchmarking assets alongside the CRIM pathway and things like that. So I think that specificity from the investors has really pushed the specificity with which we can conduct our diligence on the way in. And I think that, kind of like you noted, our hold period is typically like 3 to 5 years. It's a repurpose, refurbish, reposition play. There's a lot of buzzwords there, but the ad entry business planning and diligence perspective is certainly top of mind and crucial.
Okay, I think that's quite encouraging to hear in terms of the becoming more specific, because as we know, ESG just became a bit of a meaningless term that didn't really hold the substance. It's too broad, it's too many things. You can't please everybody through that one thing. So good to hear there is some more specificity. Inga, did you want to add to that?
Yeah, I was just going to echo exactly what Ryan has mentioned. I've been taking investor questions for over 15 years now in various kind of measures, and it was a very generalistic, what is your overall program? And I remember getting a single email with a single sentence to that effect many moons ago. And now I think as the appetite and the de-risk nature of investment and institutional investment specifically, the nuances are very acute now. And to Ryan's point, absolutely, they want to know exactly how you're integrating ESG, both from a risk but an opportunity perspective, which is really important because they have their own targets and drivers. For example, the pension funds have to answer to, the you and me of the world, and there's a set amount of time that they've got to make a profit, and there are certain strategies that may or may not be in their risk profile, but they're certainly looking outside of the typical boxes, and it's getting very specific and very nuanced, which I think is a good thing for everyone, stakeholders, top to bottom, because I think overall the most powerful change will come from investors, and drawing, just on that from our last mile logistics fund, which is our latest value add opportunity. We are an Article 8 fund as well. Similar to Ryan, we have not yet made a decarbonisation target. We're working through a gap analysis now on the fund and are hoping to make a target. But we, at acquisition, and to Ryan's point as well, on value add opportunities, they're very short life opportunities. You've really got to know your baseline going in. So at acquisition, we have a checklist to assess, what exposure we might have, either regulatory or from a decarbonisation perspective, or from a health and safety perspective. Everything has to be captured both in a technical due diligence and a ESG due diligence, which does take into effect decarbonisation. physical climate risk, and we then take those high-level budget positions, put them into the business plan, and then quickly work through to determine what is material once we get in, to the finer detail. But our IC won't sign off without those due diligences done and that capex understood from the outset.
Okay, I'm gonna certainly cover decarb in detail. It'd be great to cover it in a second. But Sonny, thinking about Hines, like how does the way in sort of look for you in terms of underwriting? What are the changes that you put in place? How do you see that evolving over time?
Sure, happy to pick it up. I just want to pick up on one point though around the kind of increasing, I guess, increasingly technical nature of the questions that are coming through from investors, because I do see that happening, and I think the list of questions is getting ever longer. I don't necessarily think that's a good idea from a value creation perspective, because I think a lot of the tools that we've established within the kind of ESG world for looking at these risks and opportunities has been more focused on impact materiality rather than on financial materiality. And I think that would apply to standards like GRES, but also green building certificates. That the emphasis has been on our impact on the environment or on society, if you're thinking about wellbeing certificates and similar mechanisms, and less emphasis on which of those issues are most material from an investment perspective. And therefore, I don't think we've historically been able to articulate as well as I would like how ESG creates value or protects value in the investments we're making. So I think that's the shift that we need to see more of within the industry. And that the reason I'm kind of recapping on that is because it is informing how we approach our investment process and our underwriting. And we've just undertaken a double materiality assessment, looking at both the financial materiality and the impact materiality. So we are looking at both, but trying to focus in on those sustainability topics that are most important and where we can feel like we can have make the biggest change that also drives value through our business. And when we think about the IC process, we made a change to the ESG section of our IC memo in November last year, where we were asking our deal teams to be much clearer about how they articulate the sustainable investment thesis for a deal, and also making that more quantifiable, so there wasn't too many kind of woolly words. And that's a muscle that we're developing. We're not getting it all right by any means, but it has created a useful framework for us to discuss the aspects of sustainability that do matter from an investment perspective. It allows us to review all the deals going to IC and to call out where we think there are financially material aspects of sustainability that are going to affect the deal, and that means the deals can be challenged in a constructive way. And the point of that is not to police those deals. From a global ESG perspective, the point of that is to get the deal team thinking as early as possible about how value can be created or protected, and so that gets priced into the deal. And as a result of that, we've seen deals go through IC now where there has been a brown discount applied on the way in, because we knew, and in that case, it was based on a capex cost for decarbonisation and particularly electrification. I don't think it will end there, but that's obviously a clear line item that can be added in now from an underwriting perspective, because there was recognition that on exit or even on ownership, that not having a decarbonisation affordable decarbonisation pathway could all either affect the attractiveness for particular tenants, particularly multinational tenants, but also on exit, that when we sell to a core institutional buyer, that they will be looking for those characteristics as part of those deals. And a couple of industrial deals like that have gone through with clear recognition that needed to be priced in from the way in. And in terms of the IC process, that's something that we're continuing to update on these particular topics. So we are updating the research section to be better informed around market data or sustainable investment intelligence, as we call it, that feeds in and informs that investment thesis. And that's particularly because each market is different. I don't think you can take a blanket approach to what is considered a good sustainable real estate investment. We're also bringing in a standardized approach to physical climate risk and linking that to the changes that we're seeing in insurance costs, particularly, in some markets, particularly in the southern US, we are seeing surcharges starting to come in to the market on top of the very rapid increases that we've seen over recent years. And then we're also looking to standardize the underwriting process through the course of this year, and that involves working with projects like ULIC Change and the Preserve tool that they're developing, which looks specifically at transition risk. Now, our changes to the underwriting won't just look at transition risk, it will be broader than that. But this is an iterative process that we think will continue to refine how we invest going in at the front end.
Thanks, Sonny.
Yeah, and not to kind of dwell on this too much, Ed, so just cut me off if you want to go in a different direction. But I think the idea, and if we were sitting on this panel like a year or two ago, I think that we'd probably all mention something with, different degrees of practice of, sustainability risk being priced in. And this idea of it being priced in was a lot more amorphous than I think it is now. And I think Sonny's example of how their IC process has changed is great and important. ULI, I think 6 to 12 months ago, released a paper, and it was pretty basic, which I think it was basic in a fantastic way of basically how to make a sustainability adjusted discounted cash flow in the real estate environment. They went through 14 different metrics, 10 or so of which could be quantifiable, 4 of which were a little bit more qualitative, listing a number of the things that Sonny's mentioned, like rising insurance costs, cost to achieve green certifications, and gave the bandwidth to make it like all of real estate is necessarily asset class and geographically specific at the property level. And I think that was really helpful. Getting market intel and then going in accordingly has been helpful for our team, specifically in Europe, where risks are a bit more salient, opportunities as well because of that. But then that allows us to answer the question that the IC will inevitably ask and raise, and importantly, especially in kind of office or lodging, which is just, is this building sustainable enough, or have we done enough ESG stuff? And then quantifying that, pricing it in, answers that question one way or another. But interesting, Sonny, that you answered that question in a no, you haven't. And here's how much, and I find that really fascinating, and still a place where there can be liquidity in the market despite that.
Great, thanks both. I think there's thank you for the questions that are coming in. Maybe the last one I'll ask here at the acquisition stage is around that age-old question of how, two things here. How do you both remain competitive in the bid process through factoring sustainability? But also, how do you convince your teams that you're going to remain competitive and it's the right thing to do? Because there's conflicting interests here, isn't there, between what your perspective is when you're maybe looking at the further forward into the operational stage and the exit, versus the deal team who may be looking at the front end with, let's say, maybe different incentives.
That's a really good question, and I'll just very quickly answer anecdotally from our point of view. I think we need to realize that sustainability factors are not in isolation, right? There's other factors that we need to consider, obviously within the deal process. And just anecdotally from a last mile logistics position, whilst the ESG credentials of the site are important and how we would uplift them, and the cost of that is incredibly important, last mile logistics is very much a location-based sector, and so location will be considered. Obviously, the competitiveness of that site will determine, what level of pricing that might be appropriate. But I do think that a lot of purchasers who are looking for sites are still considering the long-term or even short-term view of what kind of liquidity they're going to be able to get for those assets, because to Sonny's point, there are, tenants are having to really look at the efficiencies of the buildings that they are going to be rentalizing, because ultimately there's reportable factors for them, but it's a huge cost factor as well. So I think there are different levers alongside sustainability, but I do find that the more educated in terms of the nuances that go with it, the market is having to really price what, taking an EPC-F position and not being able to inject the capex required to get to, an EPC-B minimum plus whatever green standards you might be needing for an institutional portfolio level. If relevant, then you're not going to be in a great position on the balance sheet overall.
Yeah, I think to Sonny's point, it's getting that financial acumen sort of back in that process. Sonny.
Yeah, and just on the remaining competitive, I think at Hines we're trying to build a more sophisticated view and understanding of how the market is moving directionally forward, so that we can look at the value creation or potentially value erosion in terms of brown discounting as we look ahead. And I think there's more and more data becoming available that enables us to do that, so we can look at, for instance, how regulations are becoming more stringent in certain markets and what impact that will have on new build and major redevelopment versus existing stock, and how there might be a difference in competition between those types of properties. We're also taking a forward look on how we think tenant demand will change in terms of whether green low carbon buildings are wanted in certain markets, both now and over leasing events going forward. So that is building up a kind of bigger picture of what's happening in the outside market and driving the demand or not for green buildings. And that, I think, enables you to take an informed view on whether there is the likelihood of a green premium, or the potential risk of a brown discount if you sit and do nothing, or you acquire an asset that does need improvement and you haven't factored that into the underwriting. But I think remaining competitive today is, well, on the one hand, I think it's slightly easier now in a less liquid market. So if you have capital to deploy, perhaps you can have more discretion about what you don't do and don't want to factor into the pricing. But I think there is a trap there potentially in terms of if you're valuing that property and that deal on backward-looking historic market data, which a lot of the valuation is dependent on, and you haven't got a way to look forward, then there could be disparity in the market, and in some cases we won't know whether the decision we've made around whether to price it or not is right. Perhaps until we get to the exit on those deals. But I think we are getting the conviction has to build over time about that forward-looking data about how the market's changed. But I think when we look around the world in terms of our global portfolio, there are lessons we can learn, for instance, from what's happened in Europe and how the market has changed over the last few years, that we think will play out in certain markets in other locations. And I think when you look to the US as an example, you can't just take one view that market is going to move at one pace. It's already bifurcated between markets which are perhaps more regulated markets like New York, California, Boston, DC, and those markets that aren't, like Texas or Florida. Now, that's not to say you can't talk about these topics, or these topics aren't in demand in all of those markets, but the drivers are slightly different. So in Texas and Florida, there is still a lot of interest in clean energy, as an example, whether that's renewables or electric vehicle charging, as an example, which provides opportunities to generate new income for industrial assets, as an example. So why wouldn't you do that? It could make investment sense, regardless of whether you care about ESG or sustainability topics. But if in California, where you've got regulations that impact not just on building performance, but also impact on tenant and potentially next buyer behaviors, because they have to disclose their climate risk, their sustainability performance, that starts to change behaviors and demand for what's happening from a leasing point of view and on exit. So I think the demand in different markets is nuanced, and we're seeing that in Asia Pac as well. And I think, to a point that Ryan made earlier, whilst there isn't necessarily increasing demand for sustainability, I'm not sure. I think there is a little bit. I do think what we've seen in Europe is being spread to influence those other markets. So the demand and interest in conversations in North America, in Asia Pac, has increased. So and they're being challenged in different ways than perhaps 2 or 3 years ago.
And Sonny, just a couple of those points that you mentioned, thinking about buyers analysis, but also the future tenants supply and demand within maybe specific locations. Like, how are you addressing that? What approaches are you taking? Is this qualitative? Is it quantitative? Like, how do you assess what the market might be wanting in, say, 5 to 10 years?
So we've done some work looking at forward looking at lease events in our major markets down to a sub-market level for offices and for industrial space. And we've looked at the subset of tenants that are interested in sustainability features within those assets and what that might mean in terms of that sub-market demand. We've also looked at the supply of stock in those markets because that is set to change over that period of time, both in terms of whether there's improvements to the existing stock and where our assets sit within that existing stock, but also obviously new supply coming forward, which may in some cases be being built or redeveloped to a higher standard, because quite often there is a disparity in the regulations for new build versus the existing stock. And from that, you can see whether there is a demand or supply gap. And if you combine that with kind of looking at the underlying market fundamentals, you can see whether there is scope for a price differential in those sub-markets. Because in some, you're not going to the market fundamentals aren't going to be strong enough to differentiate between a brown discount or green premium. And in reality, you're just going to have to look at sustainability projects from a project IRR basis. You're not going to capture additional value. So that's something that we're starting to do. It's starting to feed into how we think about those different markets and inform brown to green repositioning strategies in a slightly more sophisticated way, we hope. Yeah,
that does sound nicely advanced. And I think I just heard a collective sigh of jealousy hearing about how you're using the research teams to think about future supply and demand from a sustainability lens. Maybe like moving the conversation into some practical examples, and I think Sonny, you made the comment about not being able to rely on financial engineering. So it is a fact that industry can't really rely on cap rate compression to drive value. So you need to look at other means. Mostly that means good asset management, driving NOI. Potentially there's an expectation of assets being on the books for longer. So from a decarb perspective, in value add, I often hear that it's not suitable for decarbonisation because of the short hold period. That's a myth. If you look at purely ROI and anything in a 3 to 7 year period, it's not going to be a big ticket item. But it'd be great to hear some examples that debunk that myth, and whether that's the brown to green transition, how it's hoping to reduce the transition to a greener economy. But Ryan, it looks like you wanted to add something there.
Yeah, I mean, I think that there's a lot of ways to think about it. I mean, so I guess on the kind of low-hanging fruit example, I think low-hanging fruit's another buzzword that people say a lot. I think especially in the value add real estate space, I mean, our key mandate, or the first part of the mandate, is to buy distressed buildings. You're either working with a capital stack that's messed up and you're sort of rescuing the current owner or lenders in a certain way, or you're buying just really bad buildings and you're making them better. And part of those really bad buildings are just poor operational credentials, a lot of which have kind of highly carbon emitting systems, whether that's bigger ticket items like HVAC units or a bad facade or whatever, or if it's just lighting replacements. And I don't want to make sustainability's easy button be LED retrofits, but just a quick anecdote there, where we've seen some stuff pretty recently, which I found really interesting. And so we work with a partner that does LED retrofits. They say at scale and has some sophisticated modeling mechanisms built in there, and it's been helpful to get pretty granular projected data on the value there and convince people that it makes sense and the ROI is good, payback period's low, all that great stuff. But what I found really interesting in this situation has been, we do the similar ESG diligence that Inger mentioned earlier, whether it's property level questionnaires to the seller, or our co-investor, or even people go in on site and look at the asset. And one of our recent projects, there are a few different parties, all of which I mentioned, that said, the lighting looks good at the building. And this is a medical office building. They say it was renovated 3 years ago, retrofitted 3 years ago. You don't need to do anything. And this partner did the audit for us free of cost. So I was like, okay, well, we don't have anything to lose. I really want to suss this out. And the payback period to do LED retrofits there is like 2 years. So I think that it's asking the right questions, or maybe re-asking questions can be helpful on low-hanging fruit. A more macro example, or I guess bigger ticket example, was there was a property in Europe with one of our partners that was performing inefficiently relative to the CRIM pathway. Our question to our design consultant was, well, what do we need to do? And their response was, spend $50 million to replace the facade and you'll be fine. Our partner helpfully said, that's not a good answer. What else can we do? Like, give me another option. And they came up helpfully with a different plan that ended up costing a fraction of that, several orders of magnitude lower, that got us to the same result, but was just more of a patchwork of things like LED retrofits, low flow fixtures, some bigger ticket things like window replacements, but just a different route. And then the last thing I'll mention, which makes things like quote unquote pencil a little bit better, is just this push to kind of the sustainable debt side of things. And here in New York, there's a pretty robust incentive program from a number of lenders, making reposition plays. So think obsolete office to better residential, greener buildings, and that's available. We've used CPACE, or looking to use CPACE more. Sustainability linked loans that actually have ratchets to material sustainability credentials of the building, not just things like DEI at the fund level or firm level, that actually matter at the property level, make things a little bit easier. Helpfully, that's all in line with what our LPs are asking for as well. So there's a bit of synergy there. So I guess that's 3 points, a couple specifics, and one more granular where I think it's making it a little easier. Then the last thing I would just say is using a simple payback period or simple ROI, I think it needs to be a little bit of a thing of the past. We're selling buildings that are going to be held in the future by somebody else to those people, not held by us for 3 to 5 years in perpetuity. So I think looking at what the actual dollars and cents savings are, and with a responsible terminal value is probably a better way of looking at it than a simple payback period. So a lot there, but yeah, I think that was a helpful question.
Yeah, thanks, Ryan. Yeah, I'd agree. I think often there is a bit of a misconception over call it net zero carbon or decarbonization. You don't need to get all the way now. It's about having that programmatical view. It's a long-term view, but the role that value add has, particularly the new assets coming in, and you're forming your capital plans. That's the great opportunity to really think how you can improve buildings beyond the bare minimum. Inga, anything you'd like to add?
I was just about to say, I can give you a practical example on that, because that's exactly some of the learnings and where we're taking forward our last mile logistics value add fund, is that because we're buying from a lot of non-institutional sellers, some very small individual sellers, a lot of the assets that we come across will be in fantastic locations and have relatively good bones, as sheds go. But, fundamentally, there might not be all of the paperwork, for every single item that we would expect. And particularly energy, right? The predominant situation with these assets is they're FRI leases, and they may not have obtained the data from the tenant. So we might have a 9-year-old EPC, which is actually completely irrelevant because there's been a change in tenant, et cetera, et cetera. And so when we're looking at the asset from the outset, there's a lot of different value add opportunities, not just in the retrofit, but actually, bringing the certification up to grade, but also, quite nuanced is that decarbonisation strategy. And to your point, Ed, in the gap analysis that we're doing at the moment, we aren't going to be able to bring the entire portfolio within the life of the fund, which is like 4 years. We're not going to bring that to a net zero position. However, if we've assessed the assets and they have, certain interventions at certain points that is clearly outlined in a pathway, once we create this wonderful institutional ready portfolio, we will have a decarbonisation pathway for that next buyer/buyers, however it gets done, and they will have a view. I think it's also important when we come to the realisation of the value at the end of the fund to really understand where those assets are and what risks, and that's not just decarbonisation, that's other aspects as well. But within, if I just go another layer deeper, within each region, within each asset, there might be, local government opportunities to, have a discount on an energy audit or a, retrofit of PV panels, and it is ever changing. So there is an ever changing opportunity to take on, certain value add opportunities as you go, and it's not one size fits all. It's very much having to look at, as we always have in real estate, every single asset's a different kettle of fish, right?
I think that's helpful to hear. I mean, what I'm hearing is that if you just pitch the building as middle of the road, just do the bare minimum, you've got that risk on exit. So you're not going to be able to validate the business plan. You're going to potentially be subject to price chipping. I'm sure everyone in the group here has tried that on the way in. So why wouldn't it be logical that people buying your assets would do something similar?
Absolutely.
And move the question, Sonny, to you. And thank you for the question that's come in. It's a timely segue. So the transition in terms of energy and carbon is certainly more commonplace, even though it has a longer time horizon, a long time horizon. It's probably shorter or more tangible than physical climate risk and adaptation. So again, similar question that we had around debunking the myth that focusing on physical climate risk adaptation measures doesn't drive value in short hold periods, because that risk is way out to the future, and really what we're talking about is weather, not climate change. Sonny, any comments you'd like to add to that?
Yeah, I think so. I mean, Ed, you were saying about how we can't rely on cap rate compression going forward, and that is going to put more emphasis on alpha. And I think in that future environment, I think it will show up where there is underperformance from an alpha perspective in terms of operating the buildings. That has been perhaps obscured in the past because we've been fortunate from an interest rate perspective, and it will show up where the strategies that we're talking about haven't been operationalized well. And as Ryan said, I think what we are talking about here is the desirability of assets, and I think it's important to link across from what we're talking about from an environmental perspective, whether that's carbon or climate, with kind of the S in ESG in terms of social value creation. And the way that we're starting to think about this is the fact that within the buildings that we own and develop or redevelop, we want those to be thriving communities, both inside of those buildings as well as around them, because that helps with the desirability. It helps protect income. And the reason for saying that is that when you think about things like climate risk or around carbon from the perspective of a well-run building is going to be comfortable. It's going to be somewhere where people want to be. From a physical climate risk perspective, we are going to see, we are already seeing buildings being affected by extreme weather events, which, and not just single big events like hurricanes, although we are seeing that. We're also seeing more numerous secondary events, which in aggregate can be very disruptive or can be costly if you've got a lot of assets in that one location. And in terms of bringing it forward, in terms of people's mindsets, I think if people start to see that more and more in particular locations, then it doesn't matter whether you're modeling out to 2030, 2040, people are starting to see that today. And what they are really seeing is significant increases in insurance costs, which, if you look at them as a proportion of income, it is going to start to affect affordability in terms of that, the cost of insurance having to be traded off against something else, whether that's rent or other costs. So that is an underlying topic that's already happening. And if we're not putting in place if we're not assessing those risks and not putting in place appropriate adaptation measures, then you could see those places become less desirable.
Mm-hmm. I think as a fact that, people, investors, whoever, are driven by fear and greed, and physical climate risk kind of ticks both of those areas. And even in Hines's home state, Texas, we're seeing increasing incidents of, not these absolute extreme events like a hurricane, but it's the hailstorms, it's the high winds. You see these offices with windows being blown out. That coupled with the high cost of insurance, it's going to start changing how people think about the design of building and which ones they wish to occupy. Another topic it'd be interesting to cover on the social side of things. Sonny, you mentioned about thriving communities. Like, how is that assessed? And also open to everyone on the call. How are you seeing social drive value in your assets, whether it's through, tenant attraction, tenant renewal, even like the rental premium side of things?
Yeah, it's a difficult one to measure, obviously. And I think, it's not often we bundle it in, obviously, with the environmental side. But the thing with environmental metrics is a lot of that is science-based. There are planetary boundaries. We know how much carbon we can emit before the planet starts to creep. From a social perspective, that's harder to do, and it can be very subjective in terms of local needs. And when we look at kind of social value strategies, we are looking very much about what that location means. So it needs to be involving the community. It needs to be involving various stakeholders to take a view. So we have major regeneration projects. For instance, we have one in Tampa where we've been very actively involved with that community in terms of trying to understand what they would like from the redevelopment around the new Tampa Bay Rays stadium. And it's giving us a bit of a toolkit there to think in a more structured way about how we're assessing social value creation over time. And we have also done something internally, which is kind of define a view on what we mean by social value, because I think it's actually it's potentially a real superpower from an ESG perspective, in that when I go around the Hines business, wherever it is in the world, the one thing that everybody wants to talk about is their community and what they're doing in their communities, either to build new buildings, to develop new buildings, to invest in new buildings. I don't always get the same response when I go and talk about the weather or extreme weather or carbon emissions. But social is a real motivating force. So I think if we can get behind that, if we can direct that energy in the right way, then we will see the outcomes. And we don't, just to say, we aren't always looking at measuring the outcomes or setting targets on the outcomes, because that can precede the conversation about what does that particular location need.
Mm-hmm. Thanks, Sonny. Any other anecdotal comment around the social side, Ryan, you'd like to add?
Yeah, I think that one, and moving towards measurement of dollars of social impact, I think is interesting. And we talk about a decent amount, and it's still a bit vague of how we're actioning it rather, and trying to crisp that up a bit more. But just the idea of community engagement in our multifamily or student portfolios, I think is pretty interesting from a value creation standpoint, just in regard to tenant stickiness and retention, production and turnover, et cetera. There are a few studies out there about this, and they all range in response rates, but there's some statistic like tenants are 100% more likely to renew a lease in a multifamily or student housing scenario if they've made one friend at their place of residence or in that community. If they've made two, that increases by additional orders of magnitude, which I find fascinating, that just the actual asset owner and operator's role in building a community there can make people's lives better, and their lives being better makes them want to stay where they are. Obviously, that's going to vary on a ton of different factors, and by the depth of those friendships, if nothing else. But just fascinating that a no cost or relatively low cost way can actually impact whether or not typically year to year environment type tenants can actually stay for longer.
I think that's a nice way to start to draw to a close with, the fact that friendship is how you create value in real estate, but maybe bring it back to brass tacks, and more of a finance answer. So we've seen in Europe, interest rates are falling. We've just seen today the news released in the US that inflation also reduced sort of month on month. So the expectation is, or hopefully, is that interest rates will fall at a sustained level. So going back to the opening comment around the reason why we're talking value add is because you're looking for higher returns because of the high interest rate environment. So let's say they do drop back to where they have been, previously. Do you think the conversations that we're having now, which are talking about the maturity of sustainability, is that going to change, or how might things evolve if and when interest rates do fall back to levels that we've seen 20 years back?
I would say, I think what we've been talking about which is essentially about future-proofing the value of assets, either through the attractiveness or desirability for tenants or for the next buyer. I think that implies to all investment strategies that we look at. And as an example, from our European core fund perspective, the strategy there remains the same from an investment perspective to look at the best possible locations to find unique assets that are impossible to replicate, but then to add value to those assets through the Hines toolkit. And decarbonisation, as an example, is very much part of that toolkit. And the challenge there is how can we deliver decarbonisation in the most cost-effective way, because we know it's going to be important for tenants of those buildings, and many they're all prime, so it's slightly different from secondary assets. But that demand is going to continue, and we think in terms of exit values as well, in terms of keeping value resilient, it's important to invest in things like decarbonisation as well as certain other. The fund has also been looking at social value as well as another important topic for them.
Okay, that's good. All change but no change. Inga, any final comment from you?
I don't want to be doomsday, but I think the return of low interest rates to what we've seen before might be a ways off. So I still think the value add proposition is going to be key for some time to come. But I do think the overarching geopolitical and physical change of which I think is here to stay, as in its disruptive nature in both the geopolitical landscape, but also the environmental and changing climate landscape, means that we are going to have to look at the factors around sustainability and ESG, or whatever you want to talk about, as fundamental to value creation within all funds, whether they're value add or standing asset. But I do think the opportunity to change existing real estate into high performing, valued, interesting, community focused assets is where the real value lays in the immediate future. And I think those who move quickest will realize those the fastest. If we may be so bold.
Thank you, Inga. I think that's a great way to finish. It's what we've heard really. It's about understanding that risk, quantifying the risk and the opportunity, particularly in the way in. I think it's key. As we've just heard, not just for value add. It's all funds. And the reason why you do that is so you can reduce costs, you can attract top tenants, you can avoid risks of price chipping. So you can really validate that business plan on exit. And I guess back to one of the first comments, given the state of transactions, exits are more limited, so you do need to stand out. You need to be a peacock in the current environment, so you can attract those core investors. So I think it's that mindset shift of, as you said, Ryan, moving beyond the ROI, the simple 3 to 7 year hold period, and thinking about those other drivers of value, which is really key. So with that, I'll draw it to a close. Thank you so much to my guests. Thank you for everyone attending. Thank you to our marketing team for bringing this together. I hope you enjoyed this session. There will be a piece of collateral that's sent out after this to summarize some of the key takeaways of how you can create value through sustainability. So with that, I'll draw it to a close. Thank you very much. Enjoy the rest of your day.
Thanks, everyone.